The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome back to the Diagnostic Trading Hour. Another great week, ready for trading the markets. And, of course, all sorts of things going on. I'm sure you've already heard about it, checked them out this morning, with the whole Spanish government having a big issue, and it's just, spreading around, and everybody's worried about what's going to happen next. And just really the story of the last few years, right? And wanted to welcome anybody to call in any questions you got about anything we're talking about today, any market. And we're talking about diagnostic trading. Call in at 877-927-6648. Again, that's 877-927-6648. Or you can call in internationally, call in at 727-445-1044. And let's take a quick look at the markets. The S&P's down, let's see, 1.25%. Small caps, the Russell 2000 there, falling quite a bit, 1.6%. And you got oil down 2.6%. And looking over at the currencies, let's see here, you got the euro dollar down 0.22, the pound dollar down 0.68, and the Aussie dollar down 1%. Also looking over at the couple of the ags there, we got corn is down 1.6, and soybeans is down 3.9% after bouncing on a lot of those highs last week. So there is a lot going on, and definitely plenty of movement there for you to capture. And so we want to talk about some of the ways that you could be and can be possibly looking at capturing that. And with diagnostic trading, what we want to do is we want to figure out how to maximize leverage, minimize risk, while taking into account 4 different areas. Not so we make our decisions based on those, but so we can see where other people make their decisions. So if we look at things like fundamentals, if we look at things like technicals, if we look at statistics, and if we look at all 4 different areas. So, fundamentals, statistics, technicals, and seasonals. And looking at those 4 areas, how does that affect people's ability to place orders? Like, where are they going to place their orders? So at standard deviations, people are going to place buy and sell orders. And that's because they're statistical traders. Other traders are going to be technical. So whenever, a MACD does this, or a Fibonacci level hits that, or whatever, they're going to place their orders. Or when this, type of chart pattern sets up, things like that. Or when you get people that are seasonally based, they're going to buy based on just it's a date. And so this is a day where this goes up, so they buy. And it's worked for the last 20 years. They expect it to work again. And so they're going to put their order in. So you want to be able to look at all those areas and bring them together. And we talked about standard deviation quite a bit last week for the last couple of days there. And it's really just an interesting thing how well it usually does work. And you can pull it together. And again, not necessarily a way to tell you what direction the market's going to go. But more than anything, it's good for profit management. And the reason that's important with profit management is because when you're in there and you're placing trades, one thing I like to do is I like to trade with Nadex. The reason I like to trade with Nadex is because it helps me limit my risk and maximize my leverage. And these markets are just, they're too volatile. And, one of the things you need to look at is, these are new times and it's a new era in trading. And are you still using the old era instruments that gave you not as good as leverage and didn't really give you as much of a chance of survival in the market? Are you still using those older instruments? The Nadex instruments are a newer type instrument. They've been around for several years, and they're owned by a very large billion-dollar company. But you need to make sure you have something in place, or multi-million-dollar company. You need to make sure you have things in place that help you protect your capital. Because if you're not able to protect your capital and manage your risk, and I'm not talking about stop losses, okay? Because stop losses, they can eat you up. You can get hit on stop losses all day long, and we all know that. But how can you really get the most bang for your buck as far as leverage goes, but not have that also get you the most risk for your buck, okay? And when you're using things like futures and forex, then you can get good or possibly great leverage, but that leverage cuts in both directions. And there's a lot of different trades you can look at. And we'll look at a few of those today. But one of the things I want to go back and look at was just, simple things like standard deviation, okay? And do a quick recap on that. We looked at that last week. And what I'm going to do is I'm going to pull up, some of y'all may have access to the Thinkorswim platform. If you don't, just you can hop on, let's see here. I want to believe, on TFNN's website. There's two places you can go. Let's see, we'll go here to the home page, okay? And yeah, right there, Thinkorswim by TD Ameritrade. So you can click on that. Also click on the Nadex banner and get a Nadex account so you can follow along with us. But so you can click on Nadex and then go over here and click on create an account. You can get a demo account in literally a few seconds. Just click on that, fill in your username, first name, last name, phone number, and your email address. Hit apply for demo. They'll send you a password. You'll be able to log in right away. And then go over here, click on Thinkorswim. You can use a bunch of these tools. They're very helpful. Click on open an account, and you'll be set and ready to go. Okay? So once you have access to both of those, then you can take advantage of the tools and the resources of both. So on Thinkorswim, you may use their tools. On Nadex, you may use their instruments. Okay? So let's say we're looking at oil, and we want to go in and we want to look at standard deviation. What I'm going to do is I'm going to set the probability date to tomorrow. Okay? And then I'm going to go down here, and I'm going to set my mode to +1 sigma, or 1 standard deviation, and -1 sigma, -1 standard deviation. And the great thing is, Thinkorswim's actually factoring in the implied volatility, and that's really important. A lot of, I guess, wannabe standard deviation formulas are literally just average true range. Okay, they're looking at historical price movement over a period of time and telling you what the standard deviation is. Well, no, that's the standard deviation of yesterday. Okay, the sigma, the implied volatility standard deviation, is the standard deviation expected from tomorrow, or going forward. So why would this be more accurate? Well, by using implied volatility, what it's using is the underlying options implied volatility, meaning how much premium is built in there based on the entire, everyone buying and selling of their options, like the VIX and things like that, but really the options even for that stock or whatever. So again, you can use this on stock, ETFs, you can use it on Forex, futures, you can use it on a lot of different things. But you go in there and it's factoring in the implied volatility, which is really the demand of the options and how much demand there is based on how much expected movement there is. So you'll see the standard deviation go way up because of the options demand going way up, right before an earnings announcement on a stock would be an example. Okay? So by using this, you can know what the market is expecting as basically a standard move, either up or down. Again, this is not so much directionally based as it is how far you're expecting it to move before it hesitates and pulls back. Okay? And then when it does reverse, you sort of have an expectation of how far it may go back. So if we look at oil, for instance, and we go in here and don't really worry about what price it is, just look at the difference. Okay? So if we check this out, and we're looking on here, and I can basically see that we have oil here at 89 and then to 91 on CL, looking at tomorrow's expected move. So basically what they're looking at is about $1.60 in movement. And so we go over and look at that, and if you're trying to do that and you want to put it together, if you want to double check your math, and I always like to double check my math every time I can, but 91.1 minus, we're going to go 89.43, $1.97, so actually a little bit more there. And I'll even double check it one more time. So 91.09 again. All right, so now just as it's moving, that's also going to affect it. So 89.42, and there we go, $1.67. All right, so that's what I thought it was. So anyways, we got $1.67 there. And so now let's go ahead and let's just look over at a chart, and we'll pull it up, and I'm going to look at oil. Okay? And first thing I'm going to do is I'm going to look at a daily bar, and I'm going to look at where it closed yesterday. Okay, and really, even on Monday, I'm looking at Friday's close. So on Friday, what price did it close at? 91.7 is where it closed. And it closed at 91, let's see here, with the close at 91.7, and I got $1.67 expected standard deviation. Okay? So if we got a close again of 91.7 minus 1.67, then that gives me my first move that I should expect, about $90.30, or $90.03 there, that I should expect it to go down to. And at that point, I may want to look at tightening my stops. And it even fell further than that today. So let's go down and let's look at and see sort of what happened just on that price time. We will see when it first came to this. Okay, so we were going down this morning, right? So this is like coming into the day. And we did actually see it sort of hesitate right here before it actually continued a whole nother level there. So we can go, okay, well, if it is going to do that, if it is going to keep going, let's say we tightened our stops but we didn't get hit, what do we expect it to go to next? So now let's go over to Analyze, and let's add another, what's called slice, okay? And we can go in, we'll add 2 slices even, because you can add one above and one below. We'll change this one to live, this one to +1 standard deviation, this one to +2 standard deviations, okay? This one to -1 standard deviation, this one to -2 standard deviations. Okay, so now what I want to look at is what is the difference between the price there and right there. Again, the price is what I'm concerned about. I'm not concerned about the difference between the prices is what I'm concerned about. So when I go over here and I look at 89.41 minus 86.19, here we go, let's re-enter. 89.44 minus 86.21, $3.23. All right, so now we got a $3.23 potential move. If we go back and just double check, make sure we got the right closing price of the previous day. So let's go over here and check it out. We got a closing price again, just to review that, of 91.7. Okay, and then we got $3.23. So now we got an expected move down to 88.47. So now let's go and look at our 5-minute charts and see how it handled that on that price level. All right, so it came down, and then literally, like we're here, we're at 88.45, okay? And it's like the low 88.38. And then it popped up, came back down for a little bit of a retest, filling a few more orders, looks like right there, before it started to pull back up. So, with that 2 standard deviation move, that's a big move. And if I was short on this, and we went 2 standard deviations, I'd be pretty happy with that, and I'd definitely be tightening my stops if I hadn't taken my position off. If I got knocked out, I really wouldn't be expecting a continued move down. I mean, there are 3 standard deviation days, but those are pretty rare, and that's just a massive profit day, okay? So, you definitely want to be looking at that and taking advantage of that, and, there's basically the whole economic slowdown, thinking oil will be lower in demand, on down the list. The Arctic drilling that's happening, thinking that may be a new influx of oil. There's all sorts of whatever, but it doesn't really matter. That's the fundamental part that you're looking at, is what might make people want to do something, like they might want to sell. But how far are they going to move? And it's amazing how standard deviation formulas work. And it's not because it's some magical formula. It's because it's literally looking at what are people doing right now with their expectation for tomorrow. So if you're over here and you were looking at, trades, then you'd actually be able to see that built in the implied volatility. And we'll check that out when we come right back. I'll show you more about implied volatility. All right, well, join me back on the next side of the commercial break. Stay right there.
Kate Stalter's exciting newsletter, Low Priced Leaders, has just launched, and now is a great time to get a 2-week free trial. Every Wednesday afternoon, Kate sends out her weekly newsletter to her subscribers, where she focuses on small cap stocks with market caps under $2 billion, as well as low-priced equities with share prices ranging from $5 to $12. Kate tracks a variety of stocks with a combination of strong technical support and solid fundamentals. Many of the stocks featured will be recent IPOs. These newer issues are often some of the biggest price gainers in the market and provide an excellent opportunity for substantial gains if timed correctly. You can catch Kate Stalter live on Tiger TV with her small cap roundup every Tuesday and Thursday at 11 a.m. Eastern Time, and visit TFNN.com right now to get your 2-week free trial to her brand new newsletter, Low Priced Leaders, while locking in the low introductory monthly rate of only $37.50 per month, almost a 50% discount. Act now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, Kate Stalter, David White, Larry Pesavento, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
Millionaires are made every day. The fact is, living your dreams is possible. Someone, somewhere is going to get rich. My recommendation is, let that be you. Each day, someone is making the decision to better themselves and creating a plan to fulfill their financial dreams. Let that be you. The key to turning dreams into reality is to take massive action. Let that be you. I'm Steve Rhodes, co-host of the Money Master Show with Tom O'Brien, seen daily at TFNN, and I can help you with your journey to great wealth. I'll show you how to create the ultimate financial edge, a set of tools, insights, and strategies that are part of my daily newsletter service, Mastering Probability. You'll have direct access to me by phone, email, and my private library of trading and investing secrets for 30 days with an unconditional money-back guarantee. I'll take your trading to the next level. Click on my name, Steve Rhodes, on the homepage at TFNN.com and turn your dreams into reality. Mastering Probability, folks. Let that be you.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to archives of those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
All right, everybody, welcome back to the Diagnostic Trading Hour with Darrell Martin here at TFNN.com. And, just a recap on markets and looking at everything that's going on so that way you can stay ready. We can check right here and we can just see sort of what's going on with the markets. We got still ES pretty much staying the same, down 1.21%. We got the Russell down 1.6%. And looking over at corn down 1.95%. And soybeans down 3.8%. So we'll come back. We'll check out those ags here in a little bit. And I want to go ahead and finish up our conversation here on oil. And we were talking about standard deviation and how standard deviation really can help you define, what level you expect it to go to. So you know where to tighten your stops. That's where you want to get really, I guess, a little bit more paranoid about tightening those stops up. And you always want to have, trailing in your stops, obviously, if you're in the right direction and you're going and you're, doing a trailing stop profit. But those are points where you should expect it to really start to turn around. And we saw that it did the same thing right here. This was our one standard deviation level and our second standard deviation level, pulled back up and saw it go down even further. And so let's go ahead and check that out. And let's see here. When we were analyzing it, the first one we were looking at was not a bad move there, but we were expecting a $1.67 move from the close of the previous day. And once you have that standard deviation level, that's really the level that you're going to use most of the day, okay? Because that's the standard deviation that was built into the options at the beginning of the day. And so looking at that, and again, you want to use standard deviation that uses implied volatility. There are a lot of great indicators out there. In the Tiger's Den, one of the ones that were mentioned is Bollinger Bands. Those are great. I like using Bollinger Bands myself. At the same time, I highly recommend making sure you have the standard deviation that includes the implied volatility number, because it's not just based on what has happened, but it's actually looking at the options implied volatility. I'm going to go more into that here in a minute, and how you can see how big of an, how that really does play a factor in the market's movement. But if we go over here and we look at this, we can also see, what did the market come down to? So it does a lot of different things for you. If we go, okay, well, it closed down there at 88.06, so I got, maybe a little bit lower than that. Let's see, I'm not trying to draw fib lines here. All right, there we go. And so we got a low down here somewhere around 87.94. Okay, so we take that level right there. We're going to look at 87.94, and now we're going to add the 1 standard deviation level. Okay, so markets start to turn around. You decide for whatever reason to fade it. You're going to go long. Your indicators, your technical analysis, the bar charts. You're just watching the charts. Where should you expect it to move? So now we're going to add that 167 level. Now we get a profit target of 89.61. Okay, well, where did the market go to? Well, it starts moving up from here, and let's see here, 89.61. Right there, we hit it. Spike a little bit above it, fall back down, market's just chilling out. Okay, so this will definitely be where you'd want to be tightening your stops. Okay, where you want to be locking in some of that profit. Should the market continue to rise, basically add another $1.67 to it, and that's where you should expect it to go to if it does continue to rise. But that's the level that you, like, if you can make that, if you make $1.67, that's a great trade. So every single tick there is worth $10. So if we basically go in there and we divide that by 0.01, you made a $1,670 profit on one oil contract. So not necessarily a bad move right there. If that was all the profit you took, and that's not including if you took it down as well, you could have made basically twice that. So I don't know, if you were in the trade or not, but that really is a helpful tool. And you can go in and there's different ways that you can play with it. After I go over some of the different ways to do it, I'm going to come back and we're going to look at something like Apple and how implied volatility has impacted it and how you might use it. We might even check out Facebook. Okay, so let's go ahead and let's pull it up and look at the Nadex account over here. And you have crude oil spreads that you can take advantage of. And you also have crude oil binaries that you can take advantage of. So you could look at standard deviation levels to either buy or sell binaries. You could also look at standard deviation levels as to where to take profit on your spreads. And where, like finding the right spread. So you're okay, when it gets down to, this level, this is where I want to buy my spread. So, we were thinking that the level was going to be right here originally. And so we were looking at somewhere around 88.50. And it went ahead and decided to push down a little bit lower. And when it did that, we would have been trying to find one as close as possible to 88.50 if we were wanting to reverse it and buy. And so you could go through and you could look at the different ones that are available. There's an 88.25. There's an 87.50. It's a little bit high. Let's see here. There's an 86. So, you can go through and you can literally scroll through and find the ones that best meet, your requirements for what you're looking for. There's an 87.50. That'd probably be one of my favorite ones right there, just because it's going to last all the way till 2:30 and give me the, the maximum chance for it, for me to be right on the trade. So, those are some of the trades that you could have looked at, just looking at, what's close to my price level right now, and where do I expect it to go, and taking that profit. So when we come back, what we're going to do is we're going to look at some of the upcoming stocks and look at things like Apple and Facebook and implied volatility and what you can expect on that. Stay right there, folks. We will go ahead and see you on the other side of the commercial break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. Would you like a personal update from Tom O'Brien as to what equities he's trading and what his daily trading plan is before the market opens each morning? Every market day, Tom O'Brien sends out his daily newsletter, Market Insights, to hundreds of subscribers that rely on his daily recommendations when it comes to navigating these highly volatile markets we're dealing with. As recently as May 21st, Market Insights subscribers closed out all 5 open positions for a combined profit of over 68% in one day. Profits ranged from 6.5% to over 24%, and all of these trades had been initiated within the previous 30 days. Now is the perfect time to get a 2-week free trial to Tom O'Brien's explosive trading newsletter, Market Insights, an $85 value. Tom breaks down the market each morning with his market take and provides trade recommendations including precise stops and target profit zones, leaving nothing left to guessing. Log on to tfnn.com today and sign up for your 2-week free trial. Make sure you're a subscriber the next time Market Insights subscribers close out multiple winning trades. Take action and sign up for your free trial today. If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of tfnn.com and sign up now.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and the Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of tfnn.com.
All right, everybody, welcome back to the Diagnostic Trading Hour with Darrell Martin. And we're looking at implied volatility, how to use that to trade, whether you're trading futures, forex, stocks, options, whatever. Implied volatility is the number one thing you need to be aware of, and implied volatility helps you determine accurate standard deviation moves for expected movement, which helps you take profit and understand where if you want to do a reversal, what prices you might want to be looking at doing that, so you can manage your risk, maximize your leverage, and really set yourself up for the best chance of success. And so looking at that, you want to use, like I said, implied volatility. So we're going to go over here and we're going to pull up just something like Apple. Okay, so we got Apple right here. And now we're going to back up. We're going to look at the daily bars. And we're going to add in on Thinkorswim. This is pretty cool. They actually have implied volatility built in as an indicator. And so of the options. And basically the way they actually figure that out, the quick summary, is they look at the front month and back month, call and put at the money options, and they take the average of all fours implied volatility, and that's the implied volatility. That's basically how they also do they come up with the VIX number, front month, back month, implied volatility of the S&P E-mini futures, and that's how they come up with the number. So anyway, so we're going to add that, and we go over here, we click on implied volatility. You do have to look on a daily chart to see this. You won't be able to see it on a smaller chart. And if we go over here and we look at this, when earnings announcements have happened. So here's an earnings announcement, and check out as soon as that earnings comes out, how implied volatility just falls down, okay? And then right here, even though there's a big up move, right, implied volatility just drops, okay? And we go over here, and we can see another earnings announcement. And then what happens? boom, market shoots up, implied volatility, basically. And this one, it sort of stayed, ho-hum a little bit because it started falling back down a little bit, picked back up. But you can really get killed on implied volatility if you're trading options, if you don't understand and look at this, because if you're buying them, then you could, on implied volatility, you want to buy low and you want to sell high. All right? And so whenever it's really high, you want to be careful on that because it can really eat you up. And, so that's why you don't go in the day before earnings announcement and buy calls or puts, because you could be right, but you could literally lose because what's called the vega. Okay? Vega is how much the option is going to move when the underlying market implied volatility changes, and it's going to change after the market makes its big expected move. Okay, standard deviation, right? So it's going to make that big move, and if you go over and you type in something like Apple over here, and you look at the options, you can go in and you have implied volatility, and you can see where that implied volatility is, and what that's telling you. If you go in and you add one other thing in, so we'll go in and we'll do our vega. Okay, and this is your most important. This is more important than your delta, and it's more important than your gamma. It's even more important than your theta, because your vega, okay, for every 1 point change in the underlying implied volatility, it can be a 64-cent change in this implied volatility's option value. All right, so the option is going to go up or down 64 cents for a move in implied volatility. That means if the option doesn't move at all, if a minute has or has not passed, all right, it can change 64 cents with just a simple 1 point move in the implied volatility, or 0.1% move. And a lot of people go, well, I'll buy further out options because that protects me. Well, let's check that out. Let's narrow it down here. Okay, we're going to go in and we're going to say, just show us, the surrounding 5 or so, and let's look at something like weeps. And check this out. Okay, the vega, the further you go out in time, the more probability there is of a movement. That makes sense, right? So because there's more time. There's more time for it to move between now and January 2014 than there is between now and July, 2012. So now a simple move in the implied volatility is actually worth $2.85. And people go in and they think, hey, well, I'm saving on theta because my theta is only 10 cents, whereas on my front month, they're 42 cents. But what they don't understand is that they're paying in the vega, and they have almost no gamma, which means they're really not going to get a huge increase with a move in the underlying market in their options value. But if there is a change in implied volatility, they are going to see a huge change in the price value of that option. So you want to understand implied volatility. You understand vega. That's probably one of the most misunderstood option Greeks that there are. And so anytime you're trading options, make sure you are checking that out. Make sure you understand it. Make sure you understand what it means and the risk that it gives to you. And if you do check out implied volatility and you are trading a stock, see what the pattern is. And you can go over here and you can look at Facebook and look at this. Okay, we had an implied volatility, just what, say a month ago, 0.47. We're up to 0.73 right now, and there's a lot of people hopping in and looking at placing trades and trying to figure out what they're going to do. And they're like, hey, what, I'm going to go and I'm going to buy puts and do all this and all that stuff. And I get that. They're trying to go in and they're trying to limit their risk and really play it. But there is a large vega, especially on the further out options like the weeps. And they are going to have that vega right there. So when that drops, okay, let's say it drops back down. Let's look at it and go, let's say this drops from 0.73 back down to, 0.5. Okay? So if we pull up a calculator on this and we go 0.73 minus 0.5, okay, that's going to be 23. All right? Let's go here and look at this option. That's going to basically be 23 points of movement there. So 23 times 0.03, not times, but 23, times 0.03. There we go. So this thing right here is going to lose 69 cents, okay, if that drops down. There's a good chance it will drop down. The news is out. It happened, whatever, So you need to expect that between, now and Facebook's earnings release. And to find that, if you don't know, you can use Thinkorswim. You can also go to a website called earnings.com. It's free. It's easy to use. And again, that's earnings.com. And go in and just type the symbol up here, like FB, hit go. And it'll show you when the next expected earnings release is. And so you got July 26th, after market close. You can also do it in here. Under their Market Watch, they have all sorts of great things that you can check out, like on calendars and stuff like that. So, but if you're trying to find it really quick and you don't know where to go, that's one way to look for it. Anyways, but just understand that that's coming. And, let's look at these options. What would happen to them at 13.6? Let's see here. We look at them. Somebody's in there and they're buying elite, trying to be, really smart and not let the time decay get them and all that. 0.13 times 26, $3.38. So again, we'll do that again just to make sure, right? But what we were factoring in, okay, was that if we looked at a drop from applied volatility from 0.73 down to 0.5, that's 23. If we go over here and we go, okay, we got a 23-point potential drop there in applied volatility because that's what it's been building up to towards earnings. We multiply that times the Vega, $2.99. So literally this option could get cut in half, all right, after earnings. So it could lose $3 of the $7 value just on the Vega, okay? And so you could be right, and, let's say it really moves. It could move, say, like $6. And so you make, quite a bit, you make a little bit extra on your delta there, right? But you're at break even. You're trying to figure out why, because you bought the call, it went up $6, you're really happy. And then you look at your profit and you're at break even because all the money got sucked out because of implied volatility. It's called a volatility crush. And so it's really something that you want to check out, you want to understand. And, just make sure you go in and you start looking at these different Greeks. There's basically 5 ways to make or lose money on options. And, Road's not really as big of an impact right now, obviously, with no interest rate out there. And we're little to no, whatever you want to call it. But, Delta, obviously, is the number one thing people look at. Gamma, it's pretty simple. It's basically just how much the delta is going to change in a $1 movement. So, like if the delta here is 50 and the gamma is 7 or 0.07, then it's going to change by 0.07 in a $1 move. So when it goes from 29 to 28, notice how the delta goes to 0.57. So the gamma is how much the delta changes in a $1 move. Theta is how much you make or lose a day, depending on if you're buying or selling the option, in time decay. But Vega, the most misunderstood of the Greeks, is measuring how much the option changes in value based on implied volatilities, move up or move down. So if you are looking at earnings plays and you're trying to figure out ways to do it, then things that you may want to look at are, what is the cycle? So Facebook, obviously, we're not going to have a big cycle, but something like Apple, should have a little bit more of a cycle. So you can check it out and see if there, is a big move. And, we see that here about a month before, it goes from 0.26 up to 0.36. And we can go over here to this one. And, this one would have been pretty tough right here because you could have bought it and it still dropped in implied volatility because the market was running up. But the standard movement, and we'll just, maybe we'll try, everything's so out of whack right now. Something like Bank of America over here. And it's just got whacked like crazy lately, hasn't it? And we check it out, and you just got to try to figure out, is there any kind of pattern? If you can't see a pattern in the implied volatility, then you're going to have a hard time figuring out the best time to buy or sell the options if you're trying to play earnings with the options. And, if you're looking for a faster move, like a one-day move, where you want to go in and get out in one day, and you want to look at maybe broader indices like ETFs, some of the major metals, and you want to look at things like that, then that's where Nadex can come into play and help you out. You can go in and you can trade the S&P 500. So if you like trading the spiders, you can go over and you can trade the US 500 on Nadex. It mirrors the S&P 500 index futures. They also have the NASDAQ 100. They have the Russell 2000. They have markets that, they have products that mirror those markets. They also have the Dow, and they got gold, silver, copper. So if you're looking at metals, you could look at those for trading the metals. And you can trade them on daily time frames, 2-hour time frames, and even weekly time frames with the binaries. So there's a lot of different options that you have, a lot of different things you look at. But the standard deviation and understanding implied volatility, its impact on your trading. If you're an options trader, it's huge. And the implied volatility, the Vega is huge if you're an options trader, understanding implied volatility and where it's at. If you're not an options trader and you're more just an outright trader, or even if you're just looking at the spreads and binaries, they're a type of option, but they're a box spread. Just understanding where you expect the market to go to, this should really help you out a lot. It gives you an objective way to look at future expected movement based upon the market's anticipation as displayed within their buying and selling of the underlying market's options. So what is everybody expecting, and how's that being reflected in the options? So anyway, so I hope that helps you out. I hope it gives you some different ideas. Biggest thing I hope you take away is always understand Vega if you're trading outright options, and definitely understand standard deviation. A couple other things to look at is we got, markets just moving like crazy. And so if we look at, soybeans and different markets like that, let's see, let's go over here and let's check out the soybean market. And let's see here. I will pull that up over in Nadex for us so we can check it out. And soybeans have just been moving a lot. So, and we want to make sure, this is really important, make sure that you're looking at the correct contract if you're looking at Nadex. So if we go over here to soybeans, we're looking at the commodities bull spreads here. We click on them. What contract is it following? It's saying it's following the August contract right now. So you're going to make sure that you are looking at the August contract. Even though the most active contract may be November for the futures themselves, they're following right now the front month, the August contract. So, so you can go with that ZSQ2, okay? And so we can go in and make sure that we're looking at the right contract, because it can throw you off because there are going to be different prices there. And there's some big movements happening. And see, is there any way that you could take advantage of stuff that's going on with the soybeans? And so let's check that out, and now let's back up and let's look at our, our standard deviation moves. And I think this thing's probably going to just blow the standard deviations out of the water. But looking at just, where are soybeans at and where could they have moved to? We got 17, so we're down to 1696 right now. And let's see here, 1696, so really 1700 is what you're looking at probably for your trade. Looking at this one, that's a little bit further down. This could be a great one as well. If it decides to do a big reversal for you. These will trade till 2 o'clock Eastern time here. But 1700, you'd be looking at a bit of a bounce back. And so should we expect a bounce back? I mean, as it moved to standard deviation, that's what you really need to be asking yourself right now. And what kind of risk, if you decided to take on this trade, would you be taking on? Well, if I took this on, I'd be looking at a $32 risk on the trade. If I did 10 of them, be looking at a $320 risk on the trade. So is there any reason to think that it might actually move high enough? Because right now I'm having to buy it up at 1701.4. That makes sense. So let's go over and look at ZS. And again, we got, I want to say it's Q2, right? So we got ZS Q2 there. And just making sure we're looking at the right thing. There we go. Okay. And now that we have that, we'll go in and we're going to add in, I'm going to go ahead and add in both slices right now. And I'm going to make this one the +2 sigma, this one the +1 sigma, and I'll make this one live. Make this one the -1 sigma, make this one the -2 sigma. So we got that on there. Wow, it's really stretched out. My goodness. All right. So just a 1 standard deviation move right now built into the soybeans. That's I didn't even think it'd be that wide. I mean, I'm not surprised, but still I'm a little bit surprised, I guess. So looking at that, we're looking at a down move of 1537 minus 1695. Really a down move of 158. So if we go over here and we check this out, and it's still not even hit a 1 standard deviation move of what they're expecting in the movement. So this thing, I mean, could definitely pull back. People are so afraid right now of the movement potential. I mean, they're saying it could go up to like 1854. And that's if we look at 1777. So we're going to back up. When we come back, we're going to look at 1777 and this move down. Catch you on the other side of the break. Make sure to call in if you got any questions. And looks like the markets are still in a rough time today. So let's take advantage of it and see you on the other side of the commercial break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now.
Catch Tom O'Brien and Steve Rhodes as they teach you the art of mastering money when it comes to trading and investing. The Money Masters, next on TFNN.
All right, so check it out, Williams. Welcome back here to the Diagnostic Trading Hour. Checking out what the standard deviation moves would mean. And as I mentioned last time, we were pretty shocked at just how high the implied volatility was. And in a lot of ways, that's not completely shocking if you think about the fact that we talked about how, we're hitting these major high-level areas, and, the market has to move a lot from this point. We talked about that on Friday on the Ags. And so if we go in and we do a little bit of math here, what we find out is we go in and we take, yesterday being Friday's closing price here, so 1777.75, and then we subtract 158 on the downside. That's a move down to 1619 would be a standard deviation move. Sometimes when you see standard deviation levels that are so incredibly inflated, and this is really is a pretty common rule, is to divide that number by 2. Okay, so 158-point move is obviously just a big move. So we're looking at already at a 3.4% move in commodities. So if we go in and we take that number and let's go ahead and just divide that by 2, and this is done a lot by some of the guys that mentored me. that were floor traders and stuff like that, is if the applied volatility is just through the roof. They're going to tighten that up. They're going to divide it by 2. And so we look at that. We look at 158.79 there. So now we take yesterday's closing price, 1777.75, and now here. So we got 1777.75, and now we're going to subtract 79 from it, and we're going to get a move down to 1698.75. And we actually did get a move down today. If we look at the low on that, went a little bit lower, 1687.50 on the day there. But I mean, that gave us a little bit more realistic move. Expecting it all to go all the way down to 1619. I mean, even as great as that would be if you're short, are you going to wait till it gets there before you tighten your stop? Probably not. And I mean, that's breaking through all different kinds of levels. So is that really what you're looking to do? So that would help you tighten your stops up. And if it's just too big and you don't want to wait that long, you could divide the number by 2 to help yourself out. Now, if we go back over and look at corn. We talked about, last week there's a lot of different ways to play this, and corn right now on the Nadex contracts is following the September contract, so you want to be looking at ZCU2 as the contract, and just make sure you're checking that out. You could look at the binaries, the bull spreads, and notice how it's really been climbing up. Even though the market's been rising, notice how the option implied volatility has also been rising. So they're expecting a dramatic move. And, usually you should not see, implied volatility going up along with it. It should be the inverse. But the fear has been going higher and higher and higher. And so you can check that out. The last thing I want to leave you with is I did check out a few things. And I called up my cousin again. He's an engineer for the railroads for BNSF. And he did state that they've been, literally taking, 2 to 3 trains with, 100-plus cars on them full of grains and just filling up silos like crazy. And nothing's coming in to take them out. And he said it's just really been an interesting phenomenon. But the interesting thing he also said, here's a fundamental thing for you, is that they're actually this should be their busiest time of year, and they're actually about to cut a bunch of staff and pull people off on the rail yard. And that's a very bad news, because that's where things start. That's the delivery, right? That's moving goods from point A to point B. And he said the last time this happened was in 2008. He almost got cut then. He was able to skate by. Now he has enough tenure that he actually is going to be safe, fortunately. But a lot of the guys, of course, are not. And but just be aware of that. That's a big leading indicator, is when the rail yards start not having enough jobs in their busiest time of the year. And so, that's coming up. A lot of things are coming up. The markets are going down. Fundamentals are looking bad. And, Europe is going crazy. So, anyways, make sure you protect yourself in your account. Make sure you survive. And, keep going and check out Nadex. If you haven't done it, hop on TFN.com, click on the Nadex banner, follow along with us, and feel free to call in tomorrow at 1 to 2 o'clock Eastern Time, and I will talk to you then. Have a great day trading. Darrell Martin, Diagnostic Trading Hour.